On a Friday, major instruments are trading nervously in anticipation of the US NONFARM payrolls for November. Markets are also pricing in the effects of a politically turbulent week, particularly in France. The emotional intensity of a trading today is set to overshadow all the market jitters experienced earlier this week. After all, the future course of Fed Reserve rate cuts and the next direction for the US dollar largely hinged on the November employment report. Against the backdrop of the brief crisis in South Korea, the situation in France promises to be far more prolonged. French President Emmanuel Macron met with the allies and parliamentary leaders on Thursday in an attempt to quickly appoint a new prime minister. The previous head of a government officially resigned a day after being ousted by a vote of no confidence from opposition lawmakers. To support the economy, France needs to implement deeply unpopular budget cuts. However, the president and his party remain a minority as the far right and far left align as a unified opposition. Any future nominee risks facing a vote of no confidence even sooner than his predecessor. France and the single currency have bleak prospects. Unfortunately, the immediate reaction from the European Central Bank is expected to address the rising political jitters in Europe or to support the euro. On the contrary, most analysts predict the ECB will lower its refinancing rate by 0.25% at its meeting on December 12. And today, the euro is bracing for a weekly decline, the fourth in the past 5 weeks. Interestingly, the US dollar 6 currency index also dropped on a Thursday and remained below 106 on a Friday, consolidating ahead of the US crucial statistics. The dollar's reaction to the NONFARM payrolls is typically highly volatile, and today was no exception. However, despite strong figures, the dollar sharply dropped immediately after the report, allowing the euro to gain ground. Before the crucial economic report, the euro was trading in the red zone, below the round technical level of 1.0600. So, the US dollar was in demand. Despite most traders refraining from making new bets, the American currency enjoys demand as a high-yield safe haven asset. Keep this in mind, as this dynamic in the euro-dollar pair is likely to persist in the short term and probably in the long term as well. As for the short-term forecast, short positions for euro bears will remain relevant after the correction completes below 1.0703. In that case, the focus will shift to the support area of 1.0000 to 1.0193, bringing the instrument closer to parity, where the euro and dollar are valued equally. Alternatively, a breakout and consolidation above 1.0703 would enable the instrument to continue rising towards the technical resistance area of 1.0790 and 1.0940. It seems the impact of the US NONFARM payrolls is so significant that the European currency was willing to overlook domestic economic statistics and react to the US labor market report even before its publication. For example, retail sales growth in the Eurozone sharply plunged from 3% to 1.9%, falling far below even the most pessimistic forecasts. Yet the euro managed to show growth, and this was all due to the expectations for the NONFARM payrolls, which anticipated a rise in the United States unemployment rate from 4.1% to 4.2%. The forecasts turned out to be accurate. The jobless rate in the United States indeed rose to 4.2% in November. Meanwhile, the number of new jobs created last month totaled 220,000, considering the forecast of 200,000 and the slight upward revision of the previous NONFARM payrolls from 12,000 to 36,000, the markets received further confirmation of the resilience of the United States economy. However, the rise in unemployment became a negative factor, putting pressure on the American dollar. Oil prices also remained in the consolidation mode up to the release of the NONFARM payrolls, with the Brent crude trading around $72 per barrel. And this caution was, of course, due to the anticipation of the US employment report. If the US labor market remained stable, oil prices were expected to rise, especially considering OPEC's plans to delay production increases. A stable US labor market is almost synonymous with the gradual growth in energy demand, while supply is likely to remain unchanged. However, the rise in the unemployment by 0.1% shifted the narrative, leaving oil prices destined to decline. As for the Russian currency, it seems largely unaffected by the United States economic data for a number of reasons. After a very brief pause, the ruble resumed strengthening its position. Surprisingly, support came from an unexpected source, from the finance minister. The ruble's weakness caused by the sanctions against Gazprom Bank, and it will stabilize in a week or two, according to the minister opinion. ANTON SILUANOV also stated that the Ministry of Finance anticipates a gradual strengthening of the ruble next year. However, the ministry has forecasted that the average annual ruble exchange rate for the coming year will be approximately 10% weaker than current levels. So that's all for today. We continue to follow developments in financial markets. Subscribe to our channel and follow news with us. See you!